All right, how's it going, everyone? Welcome to another episode of Forward Thinking Founders, where we talk to founders about their companies, their visions for the future, and how the two collide. Today, I'm very excited to be talking to Leo Polovets, who is a GP of Susa Ventures, who is here for a segment of Partner Mondays. Welcome to the show. How's it going?
Doing great. Really excited to be here, Matt. Excited to chat with you.
Yeah, I'm excited to have you here as well. I know we've interacted on Twitter, and I am just super stoked to learn about kind of how you think about venture and all things venture and Susa. So I guess to start, let's kind of start with how you decided to break into venture, just like why venture. Let's start actually there. Why did you decide to become a venture capitalist?
Deciding is probably a little bit of a generous way to put it. I definitely feel like I kind of lucked into the career without really thinking about it or knowing about it beforehand. So my background is I was software engineer for about 10 years. I was fortunate enough to be pretty early stage at a couple of companies. So I was at LinkedIn and at a location data platform called Factual at roughly the kind of 10 to 15 person stage all the way through the 50-person stage. And then between those two jobs, I was at Google for a few years. And I really enjoyed the startup experiences. And towards the end of my time at Factual, this is back in like 2012-ish, I was thinking about starting my own company. I had a couple ideas in mind, but I felt like I'd been at this like 12 to 50 person stage a few times that I'd never been at the 1 to 3 person stage. Like I didn't know what it took to get a startup off the ground. It was just a couple of co-founders in a garage. And so I wanted to learn more about that. And one of my friends from Factual was actually spinning out at the same time. And she approached me and basically said, hey, like me and a few other people, we're angel investors. We're thinking of starting a venture fund. We want somebody on the tech side to do tech due diligence as we look at companies and to see if like they're sort of, technologically sound. And I thought to myself, oh, this is great. Like, it's a kind of a unique opportunity. I'd never thought about the investing side, but I could do this for a year or two. I could meet a lot of founders at that like 2 to 3 person stage that is mysterious to me. And then that'll give me a lot of knowledge and lessons that I can apply when I start my own company. And so I thought I'd do venture for like a year or two. And instead, really, really quickly, like fell in love with the job. I actually ended up not doing much on the technical side. On the diligence side, I became just like a kind of a generalist VC pretty quickly. And so, now I've been at Susa for almost 8 years. We're in our third fund. It's a $90 million fund. And, it's been a really good experience. And I think the decision was for me to stay here versus going back to a startup was I felt like building a fund is actually a little bit like building a startup. So, you don't quite have as concrete of a product, like we're not selling SaaS software, but there is an element of like, what is our offering to founders? Like, how do we market ourselves? How do we position ourselves? So I think that stuff is fun to think about because it's almost like a startup. And then I think I just really enjoy working with a lot of founders a little bit, where, maybe I can have like 1 or 2 or 3% influence on like 50 different companies instead of focusing all of my time on one company. I think the breadth approach is more my style.
So you mentioned in there that start doing a firm, being a venture capitalist, starting something up is similar-ish to like having your own company. I think a lot of people, myself included, when they think of venture, think, oh, like all you do is just pick companies and invest in them, and that's the job. Where obviously there is a lot more that is done. Can you kind of walk me through what are some of the activities you spend your time on as a VC? And I guess if you're able to, like the proportion of time you spend on them, like I don't know if that's like a fair question, but like how much
Yeah.
time do you spend on each activity approximately, so we have an idea of scale?
Um, yeah. So I'll answer the first part first, and then I'll talk about the time allocation. So venture is in some ways, it's not quite like a funnel, but it's a little bit like a funnel where the first step is you're trying to meet with as many good companies as you can. The second step is you're trying to kind of whittle down that list of companies to the ones that you think fit your fund's investment criteria and your focus. And then once you figure out like what are the companies you want to invest in, a lot of times, especially these days, investments are pretty competitive. And so you might have, a founder raising a few $1 million and there's slots, there's enough room there for maybe 2 or 3 funds, but maybe 8 funds are interested, right? And so at that point, you kind of go from trying to pick an investment you want to do to, trying to outcompete the other funds that also want to do that investment and trying to get an allocation for yourself. And then the last step is once, presumably once you get into some of those investments and some of those startups, then it's all about trying to help them both on the business and then also later on when they're trying to raise a Series A or Series B and they're trying to support them as the company grows. And so each of these stages is really important. I think people think a lot about the picking phase, but you have to have like companies to pick from. So actually finding companies and talking to them is a really big part of the job. I think it's probably the most time consuming piece. And then these days, as I mentioned, like because it's more competitive, there's more and more time spent on trying to work with founders, trying to explain to them like how you'd be helpful, like why you'd be more helpful than another fund or another investor. And I think that ends up being a bigger piece these days because there's so much capital in the early stage markets. In terms of time allocation, I would say probably something like half of my time is spent talking to prospective founders, where it's companies we're not investors in yet, but we're thinking about investing. And maybe about a quarter or a third of the time is spent with founders where we already work with them, and so we're doing like kind of regular catch-up calls, impromptu catch-up calls when there's a problem or when somebody wants help, and just trying to help companies out as much as we can once we're already investors. And then the other 15-20% of the time is kind of miscellanea, right? So it's occasionally catching up with our own investors who are called limited partners or LPs. It's networking with other VCs and investors where we can share deals we're looking at with each other. It's doing podcasts like this one. So just kind of anything we can do to like get our name out there. Figure out ways to find to create more value for founders we work with and so on. Actually, if you Google for behind the scenes at a VC fund, maybe 2 or 3 years ago, I wrote a blog post where I actually analyzed my calendar for a couple months and posted like where the time goes. But it's evolved a little bit since then.
That's super interesting. I will, if you're listening, make sure to do that now if you want, but not if you're driving. And I'll do it after the pod. You said something
about driving these days. I feel like we're all just sitting at home.
So I'll be honest. More often than I like to admit, drive just to drive, no destination, just like, gonna go on a drive for 20 minutes, which is what I do for fun in 2020.
That actually sounds pretty good. I think that's more fun than what I do for fun, which is, these days probably just like take walks around the house and that's about it.
Well, see, I don't even I can't even walk around my house because I have a 1-bedroom apartment and I'm living with someone else. So it's like, I need to leave. And we have a nice pool, which I like sometimes take a dip. I'm like kind of finding, I guess I'm getting used to things. I don't know. It's just crazy times, which is actually, let's kind of talk about it. Let's talk about not talk about how hard things are, et cetera, but like the market changed, right? Like when you're an investor, you're looking at timing, you're looking at market, and like the market changed, not the VC landscape, but just like the market, like we're all online, consumer is different, all that stuff. How do you think about companies now with the COVID being a thing versus companies before COVID? Like how did COVID impact your investing kind of career or your investing activities?
It's been interesting. I mean, we're now, I would say almost 6 months into the sheltering in place, or 5-6 months in. And I think for the first month, it was super hectic. I think every founder was trying to raise, whether they had just raised or they were going to raise in 3 months or they were going to raise now. Everyone's trying to raise now because they thought things might get a lot worse. And then it kind of quieted down for a month or two. And then I think actually the summer's just been at fever pitch. Like it's just been as active as I've ever seen, which has really surprised me because it feels like there's definitely a disconnect between like the stock market and the venture market and then the economy and kind of people's day-to-day lives, including my own. So it's been surreal to see that. I would say like our investment strategy hasn't changed too much. We actually started out distributed as a fund. So, for the last few years, we've been in an office in SF, but for the first few years of Susa Ventures, we were split between New York and SF and LA. And so we were pretty used to meeting founders over phone calls or video calls, but maybe not in person. So that part hasn't been a terribly difficult adjustment. I think the one thing we're thinking about a lot more is like how companies look near term and what their opportunities are given COVID. And so on the venture side, a lot of times you're thinking about, is this a big idea? Can it be a huge company, in 6 or 8 or 10 years? And usually if the answers to those questions are yes, then like the near term also looks promising because, the company makes progress towards a big idea. The more progress they make, the more, the more likely that it'll raise a Series A, a Series B, grow the team. These days, I think COVID has changed that because now there's ideas that maybe in 10 years, like they look great, but in the next 1 year or 2 years, there's like very little progress they can make. right? So like, for example, anything in person, maybe it's a fantastic idea for 10 years from now, but if in the next year, like nobody's meeting in person, like your company's just not going to be able to make any meaningful progress. So we're thinking a lot about, whether COVID is like impacting companies we're looking at positively or negatively. And I think it's probably a question in pretty much every pitch meeting of just like, how does the next year look for you? And then versus how might the next 5 years look for you once a lot of the COVID side effects pass.
It was really interesting, just like the month after, like after sheltering in place, and like everyone was just kind of wondering what's going to happen. It got kind of dark, and now it's more active than usual. Do you have any thesis on why this summer is just a fundraising spree? Is it that like there's more money in the market with like solo GPs and stuff like that? But like why is it so active when like maybe it shouldn't be? I don't know. Like what's your theory there?
Yeah, these are definitely theories, but a couple of the theories I have is like one, I mean, VCs have historically just like they've been raising a lot over the last few years for their funds, and so I think there's a lot of capital like waiting to be deployed. Um, and I think part of what happened is a lot of VCs I know did take March or maybe April off to like focus on their portfolio, maybe step back, figure out their new investment strategy if they wanted to change it. But I think enough VCs didn't that, when people kind of looked back up, in late May, they were like, oh man, like the market's not slowing down. Like it's just, it's starting to just like keep going without me. Like I better keep participating. So I think there is pressure to participate on funds, and they all have a lot of capital, or a lot of them have a lot of capital sitting on the sidelines. So I think there's pressure from that side. The other thing I've seen at seed stage is what I've seen at the next round, like the Series A firms, some of them are comfortable writing big checks, like 10, $15 million checks to companies, even if they haven't met the founders in person. Um, but a lot of firms are not that comfortable with it because they haven't done it before. And so they're very used to like meeting in person, flying out to a founder if they need to. And so those firms, they're struggling to write $15 million checks. And the sense I get is a lot of them feel like, well, $15 million is hard, a hard investment to make over a Zoom call. But what if I could do this over, what if instead I did like 10 $1 million checks at seed? And so we're seeing a lot of Series A firms come down to like seed stage and do a lot of smaller checks because they feel like, well, we could still appear active and like we can, keep investing, but we're not putting as much capital at risk when like we haven't met the founder in person. So I think those are maybe two factors contributing to the pace of activity right now.
That's very interesting. I would not have thought of that, but it makes a lot of sense for sure. It's the beauty of capital, how it can be distributed. You can write one $50 million check or 15 $1 million checks. And it's all just return on returns. So what do you think about like when you get a founder coming to you, maybe it's a cold email, maybe it's a warm intro, anything like that. Like what do you look for in a founder? Or I guess I'll actually ask, like, when you have a deal come across your desk, like an opportunity, what do you look for in founders? What kind of traction, market, what's interesting to you?
Yeah, I mean, I think we have some like pretty high level filters in terms of just like what's appropriate for us and the stage we invest in. So most of the founders we talk to are raising like $2 to $5 million. Not all of them, but a lot of them have some traction by that stage. So on the B2C side, you have some users for your app or whatever product you're building. On the B2B side, you might not have a lot of revenue, but maybe you have 100K or a few hundred K in annual revenue, or at least you have some paid pilots or unpaid pilots, where it's not just an idea, but you have like a product and you have a little bit of validation that customers will pay for it. We're also focused on like US and Canada, and not really outside of that. And so for a lot of deals that we will come across our desk, they're easy to filter out because it's like, well, we're just not a fit because we focus on the $2 to $5 million rounds, and this company is raising 1 or they're raising 10, or maybe they're not in a country that we work in. So that's probably the first step and the quickest step. And then after that, we're looking at, I would say like some of the signals that we find really interesting are, one, I think most VCs would say this, but like, is this a big market? Is it a big idea? I think we've learned over time that our best investments are ones where like, even from day one, like there was a really big vision, there's a big opportunity. I think it's easier to build a big company with that as a basis versus starting small and then maybe expanding over time in terms of your vision. We like to see founder market fit. And what that means is like whatever it is that the founder's working on, it's an area that they kind of know about and have some experience in. So if you're like selling software to power plants or or energy companies, if you've never talked to one before and you've never worked in that space, you might still figure it out, but it's going to just take you a lot more like rookie mistakes and time to figure that out than somebody that has worked in those industries before. So we do like to see that sort of domain experience from the founder and whatever they're working on. And then I would say maybe a third thing we would look for, and I've really come around on this because I didn't like it at first as an engineer, is like ability to pitch well. And so as an engineer, I think I came into VC feeling like everything should be a meritocracy. If it's a good idea, like that's what should get funded. What I've grown to appreciate over time is pitching ability really matters, because the founder ends up pitching, their future employees, their investors, their customers, maybe press, and you have to be really good at selling the vision, like getting people excited about what you're building, getting them motivated to work with you or for you. And if you can't do that, it's really hard to build a big company. And so that's another element that we really like to see.
How do you evaluate salesmanship or charisma? That the kind of the last piece that you mentioned. Is it a feeling, or are there kind of check boxes that if they check off these check boxes, that they're able to pitch, they're able to sell?
Yeah, it's a good question, and I think part of it is a feeling, and people have mentioned this litmus test of like, well, would I work for this person, or would I like recommend someone else work for this person? And I think that is a good sort of gut check, right? Like if I'm talking to a founder and and this applies to them too. Like if one of us feels like, well, I don't really want to work with this person for the next 10 years, maybe that's like a little bit of a yellow or even red flag. Um, I think succinctness is probably a good litmus test here too, right? Where what I've noticed is founders with like really clear, crisp visions where they can articulate where they're going, why it's the right path, why it's a big opportunity, and they can do that in a matter of like, a sentence or two. That's really compelling versus somebody, and I'm not great at this, but like I tend to ramble on a little bit. I think if you have somebody where you ask them like what their big vision is and they sort of ramble on all over the place for 5 minutes, it's just not that compelling. And then when you hear that, you kind of feel like, well, it's a little bit all over the place. And I wonder if like this person would be good at, convincing employees to join too, if they're sort of like don't have this like really crisp, clear vision that they can articulate well.
Definitely makes sense. I was absolutely a rambler for a large part of my tech career, and still sometimes am. But I do. It is important to figure out, because if ramblers, they ramble, versus like you can keep it tight. You can communicate a vision in a couple of sentences, and you're on your way. How do you? Yeah.
And maybe really quickly, I would say like I think it's similar with pitch decks too, because I see a lot of pitch decks where it's like 20 slides, and each slide is like 2 paragraphs of tiny font text, and you can like those are actually like really hard to get through because it ends up being it's effectively like a 15-page essay spread across 20 slides. But a lot of times like the pitch decks to get investors and like investors excited, but also like where investors see the most opportunity is it's like 10 slides, there's like 5 words on each slide, and you read those 5 words and you read the 10 slides, and then you walk away from the pitch deck being like, holy shit, this feels like the future, or like I'm so convinced that this is like the right path to building whatever the company's building. And so I think that like succinctness can be really powerful.
And one more question on that point, because it's almost personal, because like this is something I've worked on and still am working on. And I know many people are like, do you have any like tips, or when a founder pitches you and you hear one is rambling, one's tight, are you able to kind of like give any tips or notice how someone can potentially tighten things up or improve the pitch or improve a sentence?
I would say I think practicing with lay people is good, right? Because I would say like I look at enough companies where even if somebody's like a little bit all over the place, I'm usually familiar enough with like whatever space they're talking about that I can kind of follow the conversation. Maybe I have like good reference points to get a sense of what they're talking about. But I think if I sort of did the like explain it to my mom test, my mom would just like probably get confused really quickly. And so I think maybe pitching your startup to like people that are not in tech and trying to get a sense of like, do they follow you? Are they confused? Do they start asking questions right away because they're not sure where you're going with something? I think that can be a good litmus test. I think time boxing is another one, right? Which is like, it's very easy to have like a 30-minute pitch because you just ramble on for a long time. And then hopefully you over time convey whatever information you wanted to convey. I think it's much harder to do something that's, like a demo day pitch of 5 minutes or an elevator pitch of like 30 seconds. And so, especially for the shorter pitches, the more you can rehearse, like, here's a good 10-20 second version of my pitch, or here's a good like 3 minute overview. Um, like, because of the time constraint, you have to be tight and focused. And so I think having a kind of a semi, a well rehearsed, semi prepared, like short version of your pitch can be really good for being succinct and being like not rambling around.
I will say last year, when we were in Jason Calacanis' accelerator, he made us pitch in front of like 6 investors. We had like a 3-minute, no, it was like was it a 2-minute timer and then 3 minutes for Q&A. And it just, the reason is exactly what you're saying. Like you, and then like if you went over, there was like a buzz or something. It was great. Like it forced you to be tight. And it kind of goes into what you're saying.
And the QA is interesting too, because if you think about it, like, if we had like 3 hours for questions, I would just ask you like every single question I could think of. But if we have, 20 minutes or 10 minutes or 5 minutes or, something like that, I'm really forced to like prioritize like what's important. Right. And so I'm going to try to think about like, well, what are like the 4 questions that really matter? And like, these are the things I really need to know the answers to. But I think when you're pitching, it's the opposite, right? Where you're thinking about like, what are the 2 or 3 or 4 things that really matter to the audience? And I just want to make sure I communicate those clearly and quickly, and sort of with like as much force as possible, and then hopefully that speaks for itself.
Yeah, that makes sense. How do you what gets you over the edge when looking at investments? Because you look at like dozens, maybe hundreds, like I don't know, like you look at tons of deals, and if I had to guess, you probably there's like right now, I would even say right now you have 10, 20, 30 that you're looking at, but there's only one can get you over the edge and like, you know what, like, let's do this one, write the check. Is there certain things that get you over the edge when figuring out who to invest in out of like 20 smart founders? Like, how do you think about that almost like in some ways emotional decision at the very, very end of it all?
Yeah, this is a tough question to answer. It's for lack of a better word, it's like idiosyncratic. So there's not like a formula where, like I talked about, wanting a big vision and founder market fit and all these things, but it's not really a formula, right? Because sometimes we meet people with a big vision and we sort of listen to it. We're like, well, it's a big vision, but maybe it's a space we don't know. Or maybe like, this is a big vision, but we think this other competitor actually has a better approach to it. So it ends up being very like idiosyncratic and specific to the company. But I would say usually the company has like some superpower, right? So they might not be good at everything, but maybe like, it's one of the best engineering technical leaders we've met in the last 6 months. Or maybe the CEO is just like incredibly good at selling and, like has this like bold, audacious vision, and we think they're going to be like amazing at recruiting. Or maybe it's, sometimes it's more industry or sector specific, right? Or maybe it's like, we've seen 20 companies in this space. We think it's like pretty crowded. None of the 20 companies stood out, but this 21st one, like they have a really clever approach and we're starting to see it working. And so we get excited about that. But so usually there's like 1 or 2 things that get us really excited, even if other areas are not as mature or not as polished.
And a couple more questions for you. What is one thing that when founders pitch you or just reach out to you, you interact with them, what do you wish more founders knew? Or what do you wish more founders like understood about venture capital so they could like maybe shoot themselves in the foot like a little less often, just based on not knowing something?
Um, I don't know if there's anything specific that sticks out. I would say like as a high level principle, I think some founders are like, they're trying to sort of like play the system, or they're trying to pitch the way that they think they're expected to pitch versus just trying to explain the business, right? So I'll see people, try to create pressure where they say like, oh, like I'm in late stages with a few funds, like, they're about to give me term sheets. They'll name the funds. I think they're trying to create like FOMO with investors. But that usually doesn't work unless it's like, unless it's really backed up with data, because investors know each other. And so if you say like, hey, you're about to get a term sheet from Sequoia, it's not that hard for me to text someone at Sequoia and be like, are you talking to this company? Or are you going to give them a term sheet? And if Sequoia says, I've never met them, or, yeah, we talked to them once, but like, it's too early for us, I think that the founder loses quite a bit of credibility. But I think another example is like, founders pitching like a growth rate that they think they're going to hit that looks really unrealistic because they think it's what the investor wants to see. And like what I really want to see is like, here are some numbers you think you can hit, and like you have a good plan for them. And I'd rather see that than like, you know, you multiply the numbers by 10 and it looks more impressive, but then when we dig in, it doesn't really make sense. So I would say like, I think that's the biggest thing of like people pitching with like people saying what they think investors want to hear versus just trying to like make like trying to you know, communicate why the business is compelling from their perspective.
You actually brought us something there, which is I've actually don't know much about, which is like how funds interact with each other. Because in some ways, funds, like you mentioned in the earlier conversation, like funds compete. Like if there's 3 slots in a seed round, 8 funds went in, like you're competing. At the same time, though, funds send deals to each other. Funds send deals upstream. So can you just kind of explain to me? Because I honestly don't know. Are funds competitors? Are they not? Is it like friendly competition? You send deals to you ping Sequoia. Like, why would you want to tell? You know, can you kind of explain that to me? Because I don't know much about that.
Yeah, I would say it's you know, at a given stage, it's usually co-opetition. So it's a little bit of a mix of collaboration and competition, but it's also, it really varies based on check size. So, you know, to break it down, like let's say a typical seed round these days is, you know, in Silicon Valley is like $3 million. And we will write checks that are 1.5 million. So maybe we're doing like a third or half of the round. So in terms of like sharing deals, if some other fund writes like $2.5 million checks, we'll basically never work with them because there's not enough room for both of us in the round. So if they're in, we're not, and vice versa. And so we're like, we'll rarely collaborate. We'll really reach out to them in terms of like looking at something together. If the other fund writes like $1 million checks, then, you know, it's a little bit tight, but like we can both fit into a round. And so, you know, we'll often be like, oh, I saw on LinkedIn you're connected to the founder. Are you talking to them? Or maybe the founder even said like they're talking to you. Do you want to compare notes? And there, the reasoning is like, can we compare notes? Can we each make decisions faster? Maybe there's a chance for us to work together and like, you know, both co-invest in the round. And then with smaller investors, it's a lot easier to work together, right? So, you know, we write $1 million checks. We're often looking for like kind of small value add funds that write 200K checks, but can pitch in some area where we don't know how to help in, right? Or maybe angels that can do the same thing. And so there's a lot of collaboration, which is angels, you know, they write a 25K check or something, and they want a bigger seed fund to like set good terms and like be the kind of the point person on the investment for the founder. You know, the one that's like talking to the founder maybe like every couple of weeks on a regular basis, whereas the angel investor might be checking in, you know, more sporadically. Or, you know, or there's like a smaller fund often has that same thing where they can write a small check, but it's not enough to catalyze the round. So they want somebody to help them catalyze the round. So in those cases, there's a lot of sharing and collaboration.
That makes sense. I have one more, and then we'll wrap it up. And this is like a very specific one. I don't know if you're able to answer because things move so quickly. But you just said like a typical seed round, or like typical seed round in SF is $3 million. I have like, and obviously some will be 2, some 4, some 1. But like, can you kind of like help me understand if the typical seed round is $3 million? Isn't that mean they're like diluting their company like a pretty heavy amount in the beginning if they're not raising like a $15 million valuation? Or I guess let me like change the question and make it a little more like, the question is, when you're fundraising and you're a founder and you're raising a seed round, how much should a founder expect to dilute or sell in that seed round? That's probably a better way to phrase the question, depending on how much you want to raise.
I would say most rounds at seed are probably 20 to 25% dilution. There's usually a minority that are under 20% and a minority that are maybe like 25 to 30. But I'd probably guess like 80, 90% are in that like 20, 25% range. And so, you know, for a $3 million round, you're probably looking at like a, you know, somewhere between like 11 and $16 million post-money valuation.
So I actually have a couple more questions about this. This is just relevant to like where I'm at right now. Like, I don't know how this works. So if you're selling, let's say 25%, if you're selling 25% of your company at the seed round, and you're for like, let's say everything just works. It's just everything's working out for the A round. Let's say you sell like another 25%. If you're supposed to raise like seed A, B, C, D, E, you know, down the line, and then the IPO. How is it possible there's like enough room to raise an E round or something, or if you're selling a quarter in seed? Can you kind of just like describe how that works, and how there's enough room for these later rounds, which is way more capital?
Yeah, absolutely. So I'll caveat with saying I have a lot of experience at like seed, Series A, and then, you know, sort of the later stage you get, the fewer companies we have that have gotten to that level. So I think like, you know, Series F, maybe we have like one company that's gotten there. Um, but the big thing here is that the seed and Series A are probably the two most dilutive rounds. And then the dilution tapers off pretty quickly. So like your seed and A, they might each be like 20, 22, 25%. It's not uncommon for the Series B to maybe be like 15 or 20%. And then after that, it's pretty common to have like 5 or 10% rounds, right? So you'd often see a Series D that's like, hey, this company raised, you know, 80 million at $1 billion valuation. And so they got a ton of money, but it was like 8% dilution. And then the other component is every time you raise money, it dilutes the previous investors. And so sometimes they have the pro rata right that lets them like kind of buy up at new price to avoid that dilution. But sometimes they don't, or sometimes even if they have that right, they can't afford it because they're a smaller fund. So over time, you know, a seed fund might buy 25%, or sorry, a seed fund might buy like 10% at seed. And then at Series A, there's some dilution from a Series A investor, but the seed fund can sort of afford to like, you know, buy back that dilution. But at like a Series B or C, that seed fund starts just getting diluted because, you know, they can't afford to invest at like a $600 million valuation or a $2 billion valuation. So their stake might go from 10% to 9 to 8 to 7 over time.
And the reason why a seed fund is like cool with that is that the value of the whole pie is getting bigger, so the value of the company is growing. So they want to exit. So although they own 5% instead of 10, that 5% is worth $80 billion or $80 million or whatever. That's kind of how that works out.
Yeah, exactly. Yeah. So initially, like, I mean, for simple math, we might invest like $1 million for 10% at a $10 million valuation. And then the company raises, you know, let's say 10 million at like, you know, a $50 million valuation later on. And so we'll pay like an extra $1 million to avoid dilution or something along those lines. But then later on, if they raise at like 200 million, 400 million, we can't really afford to do pro rata at that point. But, you know, so now instead of owning, you know, 10% of a $10 million company at seed or 10% of a $50 million company at Series A, we might own like 7%, but it's of a, you know, $1 billion company. And so that initial $1 million investment and maybe that $1 million follow-on investment is now worth like 60 or 70 million on paper.
Yeah, that makes sense. Cool. Well, I learned something. For some reason, I thought that as you go down the round, like Series C, the D round, you're more dilutive than the C round or A round, but it's actually the opposite because you're more proven. Why would you dilute more? There's more data to look off of, so it makes a lot of sense. And then I guess last question. Yeah, yeah.
Also, just like I think the more momentum you have, like the easier it is to raise money, right? Because you're no longer selling a vision. Like in some ways, I find it really incredible in a good way that, you know, somebody with a good team and a great idea can go raise like $2 million before they do anything, right? Which is that's kind of a crazy amount of money. I think that's more than like the lifetime earnings of a typical person. And you're doing that not because you have revenue, but because someone says, well, there's, you know, a 1% chance you could be a $2 billion company. And so I would invest at like a $10 million valuation today or a $6 million valuation today, because like that expected value calculation makes sense for me. But as you get to later stages, you know, a Series C company might have like $30 million in revenue, and they have a lot of options, you know, in terms of like, even if they don't raise funding, you know, maybe they're close to break even and they don't really need it. And so I think that gives them negotiating power. I think there's potentially like debt financing or revenue financing if they need to like, you know, raise some money non-dilutively. And I think also like there's just a lot more numbers to look at where somebody can be like, okay, a $30 million company growing 90% a year, you know, if I compare that to like some stock market stocks, this should be worth like, you know, $1 billion or something. And at that point, you know, the founders might not need, you know, 20% dilution and 200 million at that $1 billion valuation. Maybe they just need 50 million. And so somebody will like look at that and be like, well, this is a good valuation and I can give them $50 million. And even if it's 5% and not more, like I still think it's a good investment.
Yeah, that all makes sense. The last question for you, which is kind of open-ended, is there any, well, actually, no, I'll actually keep it, I'll keep it on a topic that's timely, which you actually just wrote about, and I wanted your final thoughts on it, and then we will call it a day. So there's this thing going on in VC land, which is rolling funds. You got like AngelList. I think AngelList pioneered this new funding model, and it's allowing a new way to collect money from LPs, and it's allowing, it's potentially like disrupting venture capital. I don't really know. You wrote a thoughtful thread about this. Can you just kind of bring us up to speed? What is rolling funds, and like, what do you think it could do for venture? And then we'll finish on that.
Sure. So traditionally, venture funds you raise one every maybe like 2 to 4 years, and you spend a lot of time raising at the beginning of the fund, especially in the early days before you have a track record. So like as a data point, I think it took us not quite a year, but almost a year to raise our first fund. And so it's a lot of, meetings with investors, like potential investors, their friends of friends. Like it's just, meeting after meeting after meeting, and it's almost like a numbers game. And one thing that makes that more difficult is there are these rules around general solicitation for VC funds where you can't just tweet out and say like, I'm raising a VC fund, like come talk to me if you want to invest. The SEC like frowns upon that. Because I think they're worried about investors being taken advantage of. And so because of that, this VC fundraising process is pretty painful. Like, so it takes, maybe the first time you do it, it takes a year. Maybe after that, it takes a few months each time. But it's a pretty heavyweight process that takes up a lot of your time and energy. I think the interesting innovation with AngelList rolling funds is they basically figured out a legal structure where now VC fund partners or like founders can effectively fundraise publicly. So they can actually say like, hey, I'm raising a fund. If you want more info, like, let me know and I'll send you a deck. But I think that ability to fundraise publicly will like speed up fundraising a lot. I think also broadening like who can see these funds. Like when we were raising a venture fund, we're basically going to our networks, but it's very much like, that's who we can approach because there's not really a good way to approach other people. But there might be a lot of other people that are interested in investing in VC funds, but don't have access. And I think rolling funds, like AngelList rolling funds, will broaden access, right? So now, when I say like, hey, I'm raising a fund and here are the details, it's not just my network that sees it, it's like anybody. And so I think that'll really diversify the LP base. I think that'll make it easier for a lot of first-time managers to raise their funds, especially if, maybe they have like an early track record, but not enough of one to go raise from like a big institution. But there's a lot of individual people that, follow them on Twitter or read their newsletter or like, something like that, where effectively like a VC can turn an online reputation into an offline fund. So I think it's an really interesting development. It feels like it would be pretty disruptive, especially for like first-time managers and for democratizing access to VC.
Yeah, I'm with all of it. I'm a huge fan of democratizing access to VC and just democratizing access, period. And this is a huge component of that. So thanks for going into that. And thanks for coming on to the podcast. We dived into some topics that you probably talk about a lot and people know about, and then some topics that like brand new to me and brand new to probably most of the listeners. So I just appreciate being open and coming on, and best of luck finding the next 20 unicorns over in your current fund.
Thanks, Matt. I really enjoyed the conversation and really appreciate the invite.